Good morning. Can you hear me?
Yes, I can.
Yeah, good. Last time you had some issues, so welcome to MFC and to India.
When do we go live? We're not live yet with the audience, am I correct?
I think we are.
Okay, good. Great.
I will start in a couple of minutes. Exactly.
Okay, no worries.
We just saw a lovely video. I don't know if you were past MFCs. So seeing pictures of
yeah, it was very nice.
Different participants over the years. So this time we're taking, we'll take a snapshot of the screen towards the end.
Okay, great.
So it'll go in the video next year. Okay, I think we'll start. I'm very happy to welcome Professor Frederic Mishkin. His research focuses on monetary and regulatory policy and their impact on the economy, as well as on financial markets. With a PhD from MIT, he has taught at many Ivy Leagues. His current affiliation is Columbia Business School and MBER. He has been associated with the US Fed, other policy bodies and central banks in many capacities. He has more than 200 articles and 20 books and is and has been on the boards of several major journals. His exemplary career combines academics and policy making, demonstrating how the two can fertilize each other, especially in macroeconomics. He was part of the early stage development of inflation targeting, which is now adopted by a majority of central banks. Especially relevant for us in emerging markets are his many articles on and sage advice to emerging markets in his role as a global advisor. After COVID-19, as inflation rises in the US, what the Fed will do and what the spillovers will be for the rest of the world is a topic of intense debate. We very much look forward to Professor Mishkin's talk on the COVID crisis and the economy. Should be economies, perhaps.
Yes.
So you have 40 minutes, Professor Mishkin, then the floor will be open for questions.
Great. So it's a great pleasure to be here. I'm sorry that I'm not in India. It's one of my favorite countries to visit. To give you an idea, the first time I visited India was in 1969, so quite a number of years ago. And one thing, of course, that makes me love India is the food. That when people are vegetarians in the United States, the food is just awful. The one place that can be a vegetarian is India because the vegetarian food is so spectacularly good. The curries are fantastic. So let me talk about the COVID crisis and the economy. And I'm going to focus on the US because it's really the center of the world macroeconomy. And what we're going to do is we're going to see that we're going to actually, let me see if I can get this to work. There we go. Let me just outline what we're going to talk about. The first thing I want to talk about is the function of financial markets and why, because we're going to see that when you try to understand what happened to COVID to the economy, we must understand financial crises. And in fact, we're going to discuss a theory of financial crises, and then we're actually going to talk about the global financial crisis and actually talk about how it evolved versus the COVID crisis, which I'm going to argue was really another test case for policy to actually prevent financial crisis. It was an incipient financial crisis. A disaster could have occurred. In many ways, it was more dangerous than the global financial crisis, but we'll see that we got lucky, that the sequence was global financial crisis first, then COVID. And we'll talk about that. And then we'll talk about policy actions during both crises. And that will tee us up. I'm not going to do this in the talk. If you want to talk about what's happening today, it'll actually lead us to many of those issues that we can discuss in Q&A. So first, to talk about the function of financial markets. The basic idea here is that financial markets are actually critical to the economy. The way I think of this, and the way I teach it to my students, is that you have to think of the financial markets as the brain of the economy. They're what coordinates allocation of capital. And if they do it well, by taking money from the so-called lenders, savers, and actually give it to people who need to borrow, who are the borrower spenders, if it does it well, the economy functions very well. And actually, this is very important to economic growth. If you want to be rich, you've got to do this right. And we're going to see the financial crises are a case where however well you're doing, you could be doing very well in your financial markets. All of a sudden, they stop working, and then you have disaster because the financial system can't allocate capital. It's like the brain basically has gone into a coma, and as a result, you have a disaster in the economy. So to understand financial crises, we have to understand the two basic concepts of asymmetric information, of moral hazard and adverse selection problems. And you're familiar with these concepts. Adverse selection occurs before the transaction is completed. So it's when you're contemplating making the deal. And moral hazard occurs after you make the deal. And adverse selection is a case where one party has adverse or hidden information and wants to do a transaction, be selected for a transaction with the less informed party. And that can create huge problems. And moral hazard is, the example of this, by the way, is think about borrowers who actually know they're not going to pay you back a loan. They're the ones that are most anxious to actually get a loan from you because they're not worried about the interest rate or anything else because they're not going to pay you back. And similarly, moral hazard occurs after the transaction is completed. And here, again, it's about asymmetric information, hidden information. But one party engages in a hidden, undesirable, it's called immoral, action that harms or is a hazard to the less informed party. And of course, this is an example. If a borrower actually borrows from you, even if they had good investment projects, they may instead take very risky investment projects that are likely to have big payoffs, but also are very likely to actually not go to fruition, and as a result, leave you holding the bag. So these two concepts are very important because the financial crisis is basically when asymmetric information, moral hazard, and adverse selection problems become much worse, and that then causes the lending to collapse and the economy to collapse. So let's talk about what a financial crisis is, then talk about the dynamics of financial crisis in advanced economies and go through the understanding of the stages, the initial stage, which involves a whole sequence of events, and then can lead to a banking crisis. And something called debt deflation is something we're not going to discuss. That's when the price level starts to fall. That has not been a feature of recent financial crises, but was very important in understanding the Great Depression, for example. So then we're going to do two applications of this theory. One is the global financial crisis of 2007 and 2009. And then we're going to look at an application of, could the coronavirus pandemic have led to a financial crisis? And we're going to see the answer is absolutely yes. And then the question is going to be, why didn't we have a major crisis in COVID? So what is a financial crisis? A financial crisis is defined as a disruption of information flows. So the financial markets can't do that job that I showed in that graphic of actually getting money from people who have excess savings to people who have good investment opportunities. And when that happens, lending collapses and basically economic activity collapses with it. And so we're going to look at the dynamics of financial crises in terms of the first stage. And the theory is sort of pictured in this graphic, which is it shows that the stage one, the initial phase, is where as a result of mismanagement of liberalization or financial globalization, that you have either three things happen: deterioration in financial institutions' balance sheets, asset price declines, or an increase in uncertainty. And we'll see that that leads to adverse selection and moral hazard problems increasing. That then contracts lending, the economy goes downhill, economic activity declines, and then frequently that leads to a banking crisis, which then means that banks can't do their job of allocating funds to people who have good investment opportunities, and also everything collapses. So we're going to look at those three top items to understand them. And the first is the deterioration of financial institution balance sheets. So here, what happens is that you have losses in the banks. The capital in the banks now goes down. We frequently call this a capital crunch. As a result, the value of the bank's assets goes down. And then the only way they can basically make sure that they avoid bankruptcy and have enough capital is to actually shrink the size of the bank so their capital relative to assets is back to normal levels. The problem, of course, is that when you contract lending, you now no longer solve these asymmetric information problems, and as a result, aggregate output collapse and investment collapses. An asset price decline has, again, deleterious effects. If the net worth of firms is going down, there are two problems. One is that there's less collateral for people to grab onto if they, in fact, make you a loan. And also, you actually have less net worth. You have actually less skin in the game, and therefore you're more likely to commit moral hazard, more likely to take on risk at the lender's expense. And so as a result, you're going to then see that people don't want to lend to people. In fact, this is the adage that the only people that can borrow easily are the people that don't need the money. And that's because they have very high net worth. If net worth collapses, again, we're going to see lending collapse, and that's going to lead to a decline in investment and output. And then, of course, uncertainty is, again, just something that actually increases asymmetric information. So naturally, it increases adverse selection and moral hazard, and as a result, causes a collapse in the economy. So that's the first stage. We then see why that increases asymmetric information, increases these adverse selection and moral hazard problems. We then see why that causes a decline in economic activity. And then the problem is that this could lead to a banking crisis, because once banks actually start to get into trouble, they may start to fail. And if they start to fail or get in real trouble, they in fact actually can't do the lending they did before. And since banks are actually special in terms of solving asymmetric information problems, it turns out that this then leads to a further collapse of spending. And that actually then can lead to even worse things happening if the price level goes down. But I'm not going to discuss that with you today. That is actually not a modern phenomenon, where in fact we very rarely see the price level fall. So let's actually now apply this analysis to the global financial crisis of 2007-2009. Understanding that GFC crisis is going to then help us understand what happened during COVID and what the appropriate policy responses are. So the initial causes of the crisis were that there was financial innovation in the mortgage markets, but unfortunately, it was something that in the long run could have been a good thing, that we can actually get people to borrow and actually lend to them safely to what we call less qualified lenders, the so-called subprime lenders. But in fact, they didn't get that quite right. And as a result, we're going to see that there are agency problems in the mortgage markets, and that created an issue. And then we're going to see that triggering this was a boom and bust in housing prices. So if we take a look and see the sequence of events, you can see there was this huge boom in housing prices. It reached a peak in 2006. And then when there's a collapse in housing prices, all of a sudden we have big problems in the subprime mortgage markets. So the losses in the subprime mortgage markets were about $500 billion by early 2008. And by the way, the way to understand what went wrong here is what the business model was that was wrong in terms of this new subprime lending, is that there was a fatal flaw in the so-called originate to distribute model. And the originate to distribute model was that instead of going to the traditional lenders, going to banks to get mortgages, what you do is you'd actually go to a mortgage broker. They would originate the loan. They would then actually have it then go to an investment bank, and the investment bank would then bundle it together in terms of new securities, this process which is called securitization, and bundling it together, they sell off these securities. The problem here was that the originator did not have any skin in the game. So they actually just got fees. And if you get fees, you basically want to do as much business as possible. You don't worry about whether the borrower is a good borrower or not. And so this is why we had all sorts of bad loans. There's a famous acronym for loans during the period called ninja loans: no income, no job, no assets. And of course, that's not loans you ever want to make, but there were a lot of them. So the problem here is that basically a $500 billion set of losses. So normally, if you think about it, you say, let's look at the stock market in the US. In a day, a 1% drop in the stock market is way more than the $500 billion losses. Yet nothing really bad happens. The problem here, by the way, is very different, because stock market marks to market every day, or every second, actually. And that's not true of banks and other financial institutions. And the difficulty is that there are losses, but you don't know where they are. And so that creates a huge asymmetric information problem, where in fact you can get what's called a run on the banking system. Well, in our case, we didn't have a run on the banking system in most countries because we have deposit insurance. We have a safety net for the banks. Instead, what happened was there was a classic run, but now not on the banking system, but on the so-called shadow banking system. And this is described by Gordon and Metric, which is the problem here is that these losses on subprime securities That does two things. One is it tells you that maybe your collateral is not very, very good. The subprime securities were being used as collateral for loans. And so when you collateralize loans, the way that it's described is to say that you have to over-collateralize them. You have to have a value of the assets that you can grab onto, which is more than the loan itself. So that's called a haircut. Usually it was around 5% before the crisis occurred, that you basically have to pledge $105 of subprime securities for $100 of loans. The problem here is the twofold now, which is there's losses on subprime securities. And as a result, there's people worrying about more uncertainty. Haircuts rise, they go to 50%, which means that you have to have a lot more collateral to make loans, which means you have an implosion of lending. Secondly, by the lower value of collateral also means you can do less lending. And so this results in what we call a deleveraging process, of sort of a vicious cycle of where people actually start to deleverage. That actually causes further losses in securities because of so-called fire sales. You have to get money quickly. That lowers the collateral value and higher haircuts. That causes more deleveraging, and you get into this incredibly negative spiral. And so this actually is a huge problem. And as a result, we actually have the economy doing less well, and financial institutions' balance sheets actually deteriorate. And again, that increases moral hazard and adverse selection problems along the line that we've discussed before. But also, you then sometimes have a failure of a high-profile firm in this kind of environment, and that means there's a huge increase in uncertainty. And when there's a huge increase in uncertainty, adverse selection and moral hazard problems become much worse again, and that sends you even further into this downward spiral. So the bottom line is we see that this set of factors which we talked about at the outset start the economy going downhill. Failure of major financial firms makes it even worse, and the economy goes into this downward spiral. That's what a financial crisis is all about. So in order to look at that, let's look at some data. One of the things that we want to ask is, was there a big increase in uncertainty? And absolutely, by looking at this data, you can see that we look at the VIX, which is uncertainty in the stock market, and there's quite a surge in terms of uncertainty in the markets. Interestingly, by the way, the surge does not occur when the financial crisis really starts, which is in September of 2007. It's August 2007 when the interbank lending market seizes up in terms of spreads that we're going to look at in a second. And it then goes on. It actually gets worse in Bear Stearns, but not super bad, but then really, really goes up like crazy during the depths of the crisis. The other thing that we see is when you have an economy going tanking like this, we have actually a collapse in asset price values. That's this net worth going down. And by the way, in all these pictures, I'm going to actually talk about three key events. The beginning of the financial crisis, which is when BNP Paribas announces that it has to close some of its hedge funds because of losses in the subprime markets. There's a seizing up of the interbank lending market. And then the Bear Stearns blow up, which occurs in March of 2008. And then finally, the big disaster, Lehman Brothers, which occurs in September of 2008. And then the market really collapses. A measure of what's problems in financial markets and the fact that there's increased asymmetric information problems is our credit spreads. And we'll look at a couple of credit spreads. The one we're going to look at most is the so-called TED spread. This is the Treasury Eurodollar spread. It tells you something about what's going on in terms of interbank markets, that all of a sudden we can see that the beginning of the financial crisis, when BNP Paribas has its problems, that people all of a sudden say, wait a second, we don't know what's going on. There's increased risk in the interbank market. And in fact, we find that the interbank lending, the Eurodollar's interest rate shoots up relative to Treasury rates. And then you get a big spike, which occurs in September of 2007. It goes along, and then we see that it goes up again in Bear Stearns, comes back down again, and then really shoots up to astronomical levels once Bear Stearns actually falls apart. So this is actually telling you exactly when the financial system is under stress. Let me not go into this because we don't have a lot of time, but we can look at other spreads as well. But the first phase of the crisis is it basically looks like it settled down. By the summer of 2008, it looked like the crisis was contained, that the TED spreads you can see were not that high. And in fact, what's interesting was that what happened inside central banks. So my last FOMC meeting was in August of 2008, when I was on the board of governors, when I was a governor of the Federal Reserve. And it was interesting, the discussion there was, some people said, the FOMC participants around the table, they said, look, things have calmed down. It's a year after the initial problems. We think we have this under control. And really what we now have to worry about is high inflation, which was actually quite high at the time. And we need to think about raising rates. Actually amazing that they were talking about raising rates just before the disaster. At that meeting, I actually got up and said, in one of the, I've been actually studying financial crises for a very long time. I started work on this in a paper that came out of my PhD thesis on the household balance sheet in the Great Depression, which was published in 1978. And then actually did research later on financial crises in general, actually looking at financial crisis in the United States from 1857 at that time to the 1987 stock market crash. The paper was well before the financial crisis. So I'd always been interested in this. And one of the things I actually said at the meeting was, don't be complacent. If you look at the Great Depression history, actually the crisis didn't really get virulent until a year after the initial shock of the stock market crash. And in fact, something similar happened here. So to show you this, I'm going to have a great economist explain what happened during the financial crisis. You're in India, you may not know these cartoons. These are Roadrunner cartoons. I don't know if any of you ever see the Roadrunner cartoons, but this is Wile E. Coyote. And he's a famous economist because he's being chased, he's dealing with the Roadrunner who always wants to eat. And he actually has the Roadrunner chasing him. And here's what happens to him. And this is exactly what happened in the financial crisis. He thinks he's safe. So this is very nonlinear, and that's exactly what happened. That these first phase, we see that how it transpired, but then you get a shock that sends you over the cliff, and all of a sudden the economy becomes incredibly nonlinear. That's Wile E. Coyote, who always ends up over the cliff, looks up and thinks he's fine, and then looks down and boom, he crashes and blows up. So we want to talk about what then happened in terms of the crisis. The crisis, basically, the kaboom, is actually Lehman Brothers. So Lehman Brothers blows up. It's frequently viewed as the key event leading to the global financial meltdown. But I would actually want to argue that by itself, it would not have done nearly the damage that many people think. It was a seminal event. But it turns out that there are three other things that happened immediately after Lehman Brothers went broke that actually may have been more important. And one was that AIG collapsed. And why did AIG collapse? Because they were taking huge risks. In fact, they were conducting something very similar to a carry trade, where you book premiums, but then actually have big risk because you're actually guaranteeing debt contracts, in this case, bonds. And of course, when Lehman Brothers went broke, that meant that they now had to actually pay off on these contracts. And AIG actually looked like it was going to go under. It didn't, because it got rescued by the Treasury and the Federal Reserve. They actually lent over $125 billion just to prop up this particular firm. The second issue is a run on the Reserve Primary Fund. This was the first mutual fund. And in fact, it was sort of ironic that it was the first money market mutual fund that was invented. And in fact, the problem was that they were supposed to only invest in very, very solid assets, treasury securities. Instead, they actually used investments in Lehman Brothers and subprime securities. And of course, when that blew up, people then realized that the collateral behind the money market funds was no longer good, and they ran on the money market funds. So it was a classic bank run. And in fact, something we call breaking the buck, that you no longer could actually write a check for $1,000 on your money market mutual fund account and expect there would be $1,000 there. And then finally, there was this issue that the U.S. Treasury really botched the initial phases in terms of dealing with the crisis, because the Treasury brought forward a bill that was basically asking for $700 billion, which was with only 3 pages of notes to give to the Congress, and said, just give me $700 billion and trust us. and the Congress then voted this troubled asset release, this TARP program down. And as a result, people no longer can count on the government as a backstop. And of course, that then means that there's a disaster. So why were these three events so important? Well, first of all, the fact that AIG occurred and the run-on reserve primary fund realized that it wasn't just risk in terms of subprime markets and Lehman Brothers. It was actually endemic in terms of the entire system. The entire system was basically taking huge risks. It was now revealed. And also then when this TARP was not passed, it weakened confidence in the ability of the government to deal with the crisis. And in fact, it was only 2 weeks later that the TARP was actually passed by the government, and that was a disaster. And you're going to see this is important to understand why, because in this case, everybody learned a lesson. They realized how bad it was, that they couldn't make these kind of mistakes, and you have a very, very different policy response during COVID than you had during the global financial crisis. So let's actually turn to COVID and look at the COVID crisis. So here's the, So here's just the same data that you can see, all the same data telling you about how this thing escalated. One of the interesting things to look at here, by the way, is if you look around the Lehman Brothers bankruptcy, you see that there's the shoot up of the TED spread that occurs when the Lehman bankruptcy occurs. But actually, if you look closely at the data, it actually receded. The spread starts to come back down. And that's exactly my point, which is that if there wasn't further problems in the markets, it may have been that this was not a disaster. It's only when AIG goes belly up and the reserve primary fund goes belly up that we see this huge increase in the spreads to the peak. And then, of course, with the failure of TARP to be initially passed. And of course, that's the disaster. So the impact of the world economy, there's a collapse in world GDP growth. Credit spreads widened, and that raises the cost of borrowing directly. That means we're going to have lower aggregate demand. Economies are going to go into recession. The decline in collateral values and deterioration of balance sheets means there's less information. There's more asymmetric information, and that also lowers aggregate demand through the collapse of lending. And so the question we want to ask ourselves is, well, there was a disaster in the GFC. Could there have been a disaster because of COVID? And in fact, the answer is very much yes. And let's look at some of the data, which is similar to the data we looked at before. Look at the VIX. VIX goes up like crazy. COVID basically, I remember that towards the end of February, we didn't think COVID was a big deal. Within 2 weeks, it was a disaster. And in fact, it was the WHO declared the COVID as a pandemic in March of 2014. So it literally was a couple of week period where we now realize that things were very bad, and VIX shoots through the roof. But what's important you're going to see is that it comes back down much quicker than it did in the other example. We have a huge collapse of the stock market, a 35% decline in asset prices. Again, notice how quickly it recovers. And then the TED spread, again, shoots up like crazy, but in contrast to the previous episode of the GFC, comes back down very quickly. And we're going to talk about why that happened. And finally, this is again the BAA Treasury spread. So could this have led to a financial crisis? Absolutely, yes. In fact, from a point of view of uncertainty and the shock, this in many ways was worse because we have some understanding of financial crisis. We had no understanding of what this pandemic could do to us. And in fact, we're still scared out of our minds. So we now have a new variant that's creating a lot of uncertainty. So if you look at the data that we just looked at, all the factors leading to up to a financial crisis occurred. The stock market crash. We see healthy firms are struggling at this point, and that could lead to bad loans and deterioration of financial institutions' balance sheets. There's huge uncertainty because of a virus. And also we saw the credit spreads went up like crazy, just as they did during the GFC. So this really looks like we could have had a financial crisis. To understand why we didn't have a financial crisis in COVID, we also want to understand why we didn't have a depression from the global financial crisis. And this is where we have a lot of luck, because the luck is that it turns out one of the people who, the few economists who really understood financial crisis, Ben Bernanke, ends up as chair of the Fed. And actually, I think he had some help. I had done a lot of work on financial crisis. Ben and I have been close friends for over 40 years. We've done a lot of research together. In fact, my paper on the Great Depression was one of the papers that actually stimulated Ben to write his famous paper in 1983 on non-monetary causes of the Great Depression, focusing on these asymmetric information problems. And so we did have some people inside the Fed who basically understood financial crisis. By the way, most people did not. Most of the economics profession did not. So wonderful quote from Ben. He's at a conference which is honoring Milton Friedman for his 90th birthday. And Ben is a governor of the Federal Reserve at the time. And he says, regarding the Great Depression, you're right. We're referring to Friedman and Schwartz, their famous book. We did it. We're very sorry, but thanks to you, we won't do it again. And then luckily, he's the guy that's going to make sure we don't do it again. So there's a bunch of policy responses. I can't go into all these in great detail, but there was aggressive Fed actions. We'll see that the Fed lowered interest rates at a very rapid rate, at a very different pattern from the usual style of operation. And in fact, we can go into it, but it's even more effective than people recognize, and some research that I focused on this. And then there was the so-called non-conventional monetary policy, which involves either liquidity provision, asset purchases, of course, these so-called quantitative easing, and also management of expectations, frequently referred to as forward guidance, which has been very much part of Fed policy in recent years. So there are also other things that were helpful too. There was expansionary fiscal policy. This huge debate on whether it was effective. It took a long time to implement, but I actually think that it's more effective than some people realize. Modern monetary theory actually now looks at the so-called, what used to be called the zero lower bound, but now is referred to as the effective lower bound, because you can be slightly below zero, that when the short-term interest rates, the policy interest rates hit a floor of zero, it turns out that fiscal policy is even more effective than it otherwise would be. So fiscal policy is also part of the picture, although I would argue that central bank actions are even more important. So let's actually look at policy, and you can look at policy in the two episodes. Look at the case of the federal funds rate. The Fed actually did something that was very unusual during the GFC. It rapidly dropped the federal funds rate from over 5% basically down to close to zero. However, it's much slower than it did it in the COVID crisis. You can see that during the COVID crisis, it did this incredibly rapidly. There were a huge number of lending facilities that were put into place. The way actually, I was there at the Fed at the time that this was done. It took about 18 months to get them all implemented. The idea here was that the Fed really wasn't sure how to do this, so they would try a lending facility out. If it didn't work, they would then actually try another one. So my view of the way this was done was it was like throwing things against the wall and seeing if they stuck. If they stuck, you keep on doing it. If they don't stick, you try something new. It was a little bit better than that because it was done in an intelligent way. So it was basically smart throwing things against the wall. And you can see that there were a whole set of facilities set up. It took about 18 months. Critically, you can also see that then when we get to COVID, they do exactly the same thing. And in fact, they create a whole set of new facilities. And in fact, instead of taking 18 months, they do it in 2 weeks. So that's extraordinary and showing how fast that they did this. And so these, and in fact, I'm very happy to share these to the conference organizers if they want people, if people would like to see these slides. Quantitative easing, you can see the first phase. They more than tripled actually during the whole period. They quadrupled the size of the balance sheet. And again, they do it again even faster during the COVID crisis. Very important, by the way, to understand that this quantitative easing is a really terrible name. The fact that the Fed actually buys assets and expands the balance sheet is not the key. So if the Fed bought treasury bills, which is what the Bank of Japan did for years, it has no effect on the economy. And the reason is that you can't drive rates even lower. What is really important was that they were buying long-term bonds and also buying private securities like mortgage-backed securities. In fact, the idea here was to change the term premiums and credit spreads between these longer term securities and the short-term interest rate, which effectively was at zero. And in fact, this is why Ben Bernanke always called it credit easing, not quantitative easing. He always said it's because we're affecting credit and credit markets. And that's the right way to look at this. It's not the actual expansion of the balance sheet per se. The expansion of the balance sheet is actually a a symptom of, or something, a follow-up of what actually you're trying to do, which is actually to try to affect the credit markets. And these programs are very effective. There's a lot of research on this. The research indicates that these asset purchases lowered long-term rates by about 50 to 100 basis points, which is a very large move. But again, it's only effective because it was really credit easing. So let's look at, and as a result, we didn't have a depression. So Ben helped save the world. But now let's ask, why did the coronavirus pandemic didn't lead to a financial crisis? Why did we actually see just a couple of very bad months and then a very, very rapid recovery? And the answer here is that we got lucky. How did we get lucky? It's lucky that the sequence was that we had the GFC before COVID. And why was that important? It was important because, number one, the Federal Reserve had just actually played a war game. They had learned what to do when financial markets seize up along the lines that they did during the GFC. And they could just bring out the same tools, the same weaponry to basically make sure the credit markets function. And in fact, they did this incredibly fast. They resurrected the GFC lending programs by March 14th. I think it was actually March 11th that the pandemic was declared. But by the end of February, people were not talking about a pandemic. So within 2 weeks, they basically got things rolling, and within 1 week of a pandemic being declared, and instead of taking a long time, a year and a half to develop them. They cut the federal funds rate even faster, I showed you that. And also they created a whole set of new programs to lend to non-financial institutions, small businesses, corporations, state and local governments. The way I like to think of this is, this was a GFC lending on steroids. They even extended it, again, because of this experience of the past. And then finally, the Congress passed legislation, instead of screwing it up by turning down TARP and taking a long time to pass expansionary fiscal policy, they did it within 2 weeks. It was really, really extraordinary. Even more extraordinary, because you're not as aware of this, but the partisanship in US Congress right now is absolutely horrific. It's just, it's the worst we've ever seen in the United States, maybe except before the US Civil War in the 1850s. And yet, in this case, within 2 weeks, they actually passed a bill, a $2 trillion bill. So this explains why the performance economy is so much better during the coronavirus pandemic. You can see this, that here is basically the unemployment rate shot up and comes back down. In fact, it's now even lower than this this graph shows. That you can see that the effect on the inflation, it really did not cause inflation. In fact, this is actually important. A lot of people think that quantitative easing, active Fed actions automatically cause inflation. Not if there's a big negative demand shock. And that's exactly what happened here. Indeed, we did not see inflation go up during the GFC. In fact, it actually fell negative for a period of time. And similarly, we did not see a lot of inflation in the initial phase. And my view is that both the Fed and the Congress did exactly the right thing by hugely expansionary policies starting in March of 2020, when they were faced by a potential depression and global financial crisis. So I'm not going to spend a lot of time in the aftermath, because maybe we'll talk about that during the Q&A. But actually, has there been a problem lately? And I would argue very much yes. That the government then passed another fiscal stimulus bill, $1.9 trillion spending bill in early 2021. And in fact, I think this was a very bad bill. There were very strong reasons why it was about more than double what was needed. Had provisions which basically made it more likely that people would stop searching for jobs. And furthermore, that was with the situation which I think would lead to another aggregate demand shock, which is that people couldn't spend during the crisis. So I'm somebody who is a foodie. I love food. It's one of the reasons I love India is because I love the food. And I couldn't eat out for 18 months. And as soon as that I got vaccinated, I started going to restaurants like crazy. So it turns out that most Americans' financial balance sheets were better off after the COVID. that people had a huge amount of savings tucked away. What did they do? They started spending, and then the U.S. government increased spending by way too much. And then also, I think the Fed has made some serious mistakes by actually accommodating this, by keeping monetary policy much too easy. And again, I want to stop so that we can have our Q&A. So we basically had a situation of very large demand shock. The way the Fed has talked about this is they said, oh, inflation is going to go back down because really the inflation is higher because of the so-called negative supply shock, the fact of all the supply chain disruptions. But that ignored the fact that there was a very large positive demand shock, both from pent-up demand and also from this expansionary fiscal policy. And so in that context, I think the Fed has gotten behind the curve. So why don't I stop here and that actually open this up to Q&A, and I'm happy to talk to you about whatever you want to talk about in our last 20 minutes or so.
Thank you. It is really nice to see such a well-reasoned explanation for why a large sort of liquidity infusion or helps in preventing a crisis. Because I think what has been happening is that we've had so much of this after the GFC, that people now are worried about too much liquidity. And so one mostly hears that. In India especially, this is similar. We had very timely kind of infusion very quickly when COVID struck. But we've not, it's not because of continuing uncertainty, and we haven't had the kind of fiscal stimulus. Therefore, we've not sort of withdrawn it. But inflation is much lower than the US and within our tolerance band, but people are worried because some parts of inflation are still. But one question I had was that I'll just start before taking up the questions that are just coming in. So I'll have a look. That this last decade after the GFC, there were a lot of negative spillovers for emerging markets. There was a Euro bond, there was the Fed, the taper with Ben Bernanke. So could things have been better managed in that respect? Would some faster, how could this have been? Was it due to too much liquidity creation, or was it due to something else that something could have been done about this?
So I actually think that the answer is the problem in the initial crisis is the Fed might have done a great job, but not good enough. It could have done even more. It was a little bit slow. I actually took that view when I was on the board, that I actually took a position in the FOMC that we were behind the curve and needed to go even faster. I did that in December of 2007. Actually, there's interesting dynamics there that I wanted to dissent from the policy, which I did not feel was aggressive enough. But if a board member, governor dissents, it's a very big deal in the US. And it would actually look like I was not supporting the chairman, who I definitely did support. So in fact, one of the things that people have said, oh, the Fed, the US is increasing all this liquidity during the GFC, and that's actually going to cause the US dollar to depreciate, and therefore that's a problem for us. I think that actually is not correct thinking. This was also the discussion of so-called currency wars and things of that sort. The issue here is that if the US didn't take these actions, so when a central bank takes actions to actually stabilize the economy and the world economy, by the way, that actually, even if it creates an issue for you that your US dollar is depreciating, your currency is appreciating, it's still, you're far better off than them not doing this, and the whole world economy collapses. So I actually think that kind of thinking is very problematic. The one issue I think currently with the increase of US liquidity is that this does spill over to the rest of the world. It could potentially create an inflation problem for you in India, not because of what you're doing, but because of what we're doing. So if policy actually during the GFC, we needed very expansionary policy, and we needed to keep it up for a long time because inflation actually fell below our inflation target. So basically, that was a serious problem. We're now in a situation where the inflation target has been breached by a very, very large amount. We can discuss, I think people want to discuss more about what I think Fed's policy mistakes are. I'm very happy to do that and talk about why I've been very critical of the Fed over the last year in my public pronouncements on it. But it now is actually a case where the US doing this very expansionary policy, I think, is a problem for other countries. And that's because it's not good policy for the US. So the bottom line is that people talking about currency war, immediately after the GFC, they got that completely wrong. Yes, it created some issues for them because their exchange rates were appreciating and they didn't like it. But on the other hand, much worse is if the US stopped buying their goods. And that's what would have happened if we didn't do what we needed to do.
There are a couple of questions on why there was no crisis after COVID, apart from what you have said. They're saying that maybe financial institutions were in a better shape. The housing market was not overheated. Would you agree with that?
Yes, I definitely would agree with that. So one of the successes of the aftermath of the GFC is that we changed our regulatory structure that making all these bank loans is not easy. In fact, it's gotten so difficult. I just actually tried to get a mortgage loan on a property that I own, and I got turned down. And I was shocked because I had more money than I ever needed. It was just basically I wanted to refi to get a lower interest rate on this small mortgage. The conditions so tight that the banks, the good news for that is the banks are actually very healthy. And so we're much better able to withstand this kind of shock. So yes, absolutely, that was true. However, if we did not do what we did in terms of March 2020, the shock could have been so large that even though the banks were extremely good shape, that they still would have taken too big a hit. And so that would have been exactly the kind of issue of what we have sometimes in these stress tests that can create some issues.
Now, the other set of questions seem to be about that the Fed acted very wisely in 20, but it's not acting so wisely now in 21. So what is your view on the governance, or how can...
it's not so much governance, but I'm going to be quite critical of the Fed and of Jay Powell. I think Jay did an extraordinary job, and the Fed did an extraordinary job in March of 2020, and they deserve huge amounts of credit for that. There's sort of, in the past year, I think that the Fed has made some serious mistakes. And as I say, I think also the Biden administration has made some serious mistakes. But to be honest with you, the central banks should be of a higher calling. Politicians make mistakes because it's in their self-interest to make those mistakes. They want to have expansionary policy, frequently just too expansionary. I'm sure you deal with the same issues in India as we deal in the U.S. on this issue. But the Fed should have known better. So here are the three mistakes that I think that the Fed has made. The first mistake is that the Federal Reserve accepted the view that the Phillips curve is dead, that they didn't have to worry about operating in a high-pressure economy. And in fact, I did research on this issue for the U.S. Monetary Policy Forum, which I co-direct, which several years ago, which said that actually is a very dangerous thinking, because what we showed in our research is that the Phillips curve would be very flat, actually would not respond much to slack in the economy, only if the Fed actually does its job properly of heading off incipient inflation and being proactive. And in fact, the way we described it is the Phillips curve is not dead, it's hibernating and could come back again if in fact the Fed doesn't do its job well. So one problem is that they basically felt that they could just keep on pushing employment higher and not have negative inflation consequences. That's problem number one. Number two is they talked only about the negative supply shock, but there was a huge aggregate demand shock, that positive aggregate demand shock. And that means that the inflation was not going to be that temporary. It was going to be much more permanent. So again, I think there was bad thinking. There's a third issue, which is a policy that I actually approved of very strongly and written in favor of and research in favor of to move from what we call flexible inflation targeting to flexible average inflation targeting, which is instead of shooting for a point target of 2%, you want to average 2% over a period of years. That actually is a very good policy. It has very nice expectations dynamics. There are a lot of reasons I can go into why it really makes a lot of sense. The problem is that the Fed has not actually been specific enough about this. And this is a general problem under Jay Powell, which is the Fed has not been very transparent and is not nearly as transparent as it needs to be, both on its forward guidance which again, I've done research saying that the Fed needs to explain how it will react to future events. It was very poor at doing that. And also very poor in terms of actually not describing what average inflation targeting really is. When you average, if you don't talk about a horizon over the average, the period over which you average, it doesn't mean anything. So if you actually say, I want a 2% average, oh, but the horizon, we average over 50 years, it means that if inflation is above 2%, you don't have to worry about it, right? That's exactly what they did. And in fact, I was very, very critical of them, very disappointed in this. They needed to specify that the average was over 5 years, a business cycle like the Australians do it. The Australians say it should be averaged 2.5% over the business cycle. The Fed didn't do any of that, so they've never been willing to talk about how high inflation should go and how temporary it should be. And so this is actually terrible because it weakens the actual nominal anchor. And there actually are reasons to suspect that inflation expectations are getting unanchored now. So that's sort of those three combinations those three combinations with overexpansion of fiscal policy is very bad. Now the Fed, to its credit, is now finally realizing that they've blown it. And and they are talking about it's going to happen today. They're going to taper faster. They're going to talk about raising rates faster, but they're behind the curve. And the danger could be that they get so behind the curve that we have the 60s and 70s again. So the way I describe this is that you guys may not remember this, but we all wore bell-bottom pants in that period of time. I don't know if they did in India, in the US. So there's a fear that could we get bell-bottoms back again? The answer is, I think, it's unlikely because the Fed is not going to make the disastrous mistakes they made in the 1970s. But on the other hand, I think that it's going to mean that the Fed eventually will have much more inflation than they wanted, and will have to raise rates by more than they otherwise would. And that's very bad for the economy.
Yeah, there are a series of some questions about fiscal monetary coordination. President is asking that is the lesson that...
Oh, Shima, can you talk a little bit louder? I couldn't hear you.
Yeah. Questions about monetary and fiscal coordination.
Shima, you have to go closer to the microphone. I'm having trouble hearing you. Just talk louder.
Yeah, fiscal monetary coordination. Does the FISC have to respond immediately? Should the FISC respond immediately?
Yeah, Shima, unfortunately, I don't know if it's happening with other people, but you're going in and out on me. I'm having trouble understanding it. It's actually not you're speaking loud. There's some problem with your connection, I think. Okay. So maybe try again.
Okay, fiscal monetary coordination. Maybe you can have a look at the chart yourself. Can you hear me now?
I can only hear the beginning. That you said about fiscal, monetary fiscal policy coordination. So let me talk about that. I couldn't hear you. But clearly, that you always need to coordinate. And in fact, in this case, the problem here, it's a little bit difficult because central banks really can't tell the fiscal authorities what to do. And they shouldn't. There's a big problem for central banks going forward in the future, which is that after this COVID crisis, the central banks are now involved, particularly the Fed, is involved in markets which it's never been involved in before, and private markets. That's very dangerous. You really don't want them to basically to go too outside their basic mandates. There's also a lot of pressure on central banks to add new mandates to them, which I think are terrible ideas. The monetary policy cannot solve income inequality. Monetary policy cannot solve climate change. Those are, to me, very, very important issues we need to deal with. But that's what our politicians have to deal with, not the central bank. It's very, very dangerous to have the central bank get into areas that it shouldn't. So this really, the Federal Reserve can't basically tell the fiscal authorities what to do. Behind the scenes, they can. I think that they were probably not. Jay Powell, I don't think, was telling them to Biden to have a smaller than $1.9 trillion package. I think that was a mistake, but in public, they couldn't do much about it. However, one of the things the central bank does need to do is to say that if the fiscal authorities do the wrong thing, we're not going to accommodate it. And in fact, that was done in this case. So I think the mistake here, again, is that the Fed basically kept pursuing very expansionary policy in the face of overly expansionary fiscal policy. So in that sense, if there was coordination, it was the wrong kind of coordination. Shiva, I can't hear you at all. I literally don't hear you at all. I can't hear you, I'm sorry.
Crypto, can you hear me now? Cryptocurrencies?
I can hear you now, yeah. Yes.
Cryptocurrencies?
I can hear you now.
About cryptocurrencies, your views
Yes.
on cryptocurrencies.
Again, all I could hear was two currencies.
Crypto.
I'm sorry, I'm just not hearing you as well as I would like.
Okay. Maybe you could see the chat box yourself. There are a lot of questions in the chat
Okay,
box.
no, actually, by the Ashima, whatever you just did, now I can hear you.
Okay. Well, there are a lot of questions about cryptocurrencies. You know, in India, we are thinking of a bill. So what is your view on that? Should it be regulated, banned?
So it turns out that this is, yeah, I'm not an expert on this. And in fact, at our next US Monetary Policy Forum in February, we're going to have a panel on cryptocurrencies. And I'll probably be able to answer your question much better when I've seen that panel.
Right. I think it's a hot topic. But let's go back to the fiscal monetary issue. Because I think that in India, or after the GFC, you did not have the fiscal response that was required. The CAP was delayed. In India, we have a problem, high debt and so on. So do you think that where you don't have that much fiscal support, you need to continue with monetary accommodation for longer? So how do you decide an exit time? Because there are people who are worried, there's so much liquidity. How are you going to take this back?
Yeah, so I think that this is always a problem. This is a frequently problem for developing economies. They don't have the fiscal space that advanced economies have. And the US, by the way, has even more fiscal space than others because it's a reserve currency. Everybody uses the dollar. So the problem here is that for developing economies, they can sustain debt to GDP ratios, which are much, much lower than you see in advanced economies. And so that means that in a crisis, they are actually going to have much less ability to use fiscal policy to deal with the crisis. My view is that's exactly why you need monetary policy to come in. It may not be the most desirable way of doing it because you'd like to use both. But I think some people have said, well, it's terrible to have the central bank do the expansionary policy because it's artificial. It keeps rates at too low a level. My view is I don't agree with that. My view is that if the economy is basically too weak, if inflation is too low, the central bank's job is to keep the economy at full employment and also keep the inflation at 2% or whatever target level you have. And if the fiscal policy is not optimal, you still need to do it. And so this was a criticism that people made during the GFC. Some people made exactly the same criticism in March of 2020. I thought they were dead wrong. The problem now is that that we're not in a situation where unemployment is too high, but probably too low given what's happened in labor markets, and inflation is way too high. So this is a case which is a very different environment right now, and the argument for the Fed to be tighter is that they're not doing the job the way that they need to do the job in order to control inflation, and that's the big problem.
What is your view on the taper? Because people here are worried, in emerging markets in general, that as the Fed exits, you know, if they announce faster withdrawal, then you'll see a lot of outflows from emerging markets. A repeat of what happened in 2000.
So, you know, the problem always for emerging markets is the following, which is you're like the ant in the room with the elephant. And when the elephant moves, boy, you can get squashed. And to be very frank, when the U.S. monetary policy is decided upon, when you sit inside around the big table at the FOMC, the discussion is never about how can we help India, how can we help Mexico, or help any other country. It's always about what is the right policy for the United States of America. And actually, I don't think that's a terrible policy, because the bottom line is we're so important that stabilizing the U.S. does stabilize the rest of the world. but it creates a huge problem when your economies are out of sync with what's happening in the U.S. economy. So that in the context of emerging markets, when U.S. is pursuing expansionary policy, and you're also in a situation where your inflation is too low and output is too low, then actually you shouldn't worry about the fact that if the U.S. dollar is going down, you should then actually just pursue more expansionary policy so the rupee doesn't go up. And in fact, that was sort of part of the mistake that was made during the currency war discussion by countries during this period. So, however, there are times when, in fact, your situation is different from the U.S. And then if the U.S. is doing what's good for the U.S., it can be bad for you. This is just life. I think what it says is that emerging market economies have to frequently protect themselves, recognize that they can't do anything about the U.S. It's going to do whatever it's going to do. And if the policy is not what you want, you have to make sure that your financial system, for example, can withstand that.
Right, and to be able to absorb shocks and do something countercyclical.
And exactly right. And you have to.
An issue, you know, when Ben Bernanke announced, it led to the taper tantrum, but later on, Janet Yellen raised rates, because she did it in sync with employment, and markets were calm. Nothing happened. You know, there was no big reaction from financial markets. So better communication. I think that's a lesson perhaps the Fed has learned, that if you but currently this sharp inflation is again creating an issue that will they have to withdraw faster. Right.
So I think that the issue of tapering, the Fed did learn a lesson about how not to do that. And in this case, I think that the Fed has been much better at telegraphing what it plans to do in terms of tapers and how it links to monetary policy. So, for example, that we are having an FOMC meeting that's going to be announced today at 2:15 in the United States, at 2 o'clock in the United States. The Fed has clearly signaled that it's going to increase the rapidity of the taper, and it's going to actually raise rates sooner. So I think that the Fed is now starting to communicate much better than it did in the past year. So my criticisms of Jay Powell were that the Fed basically said we're going to keep interest rate at zero, and no matter what happens, we're not going to tell you what we're going to do. That I think was a big mistake. And again, not communicating well about their new average inflation targeting policy again was a very big mistake. The Fed's doing better lately, but still there are problems in this regard. But I think that the problems now are just that policy got behind the curve, not that they didn't communicate well enough about the taper.
Okay, so we are exactly at 9. If you're willing to spend a little more time, there are more questions in the box.
I can spend a few more minutes. I'm happy to do so.
Okay, so one big worry is that, you know, this is a question I have actually, that the way the Fed has announced, you know, it does not reduce its balance sheet. It lets the securities, you know, as the term gets over and so on, and slowly it will shrink. But in India, the Reserve Bank did expand its balance sheet, normally does not. So liquidity is about 11 lakh crores.
Ashim, I'm sorry, I can't understand the last bit. I got the first part.
So liquidity is high in India, and the market expects that this should be withdrawn instantly. You know, they don't expect an expansion, accept an expansion in the Reserve Bank's balance sheet. So why is there this difference between the US? You know, they are able to keep their balance sheet expanded without it, and in fact, they regard that as good for calm.
Yeah, so I think that I don't really know enough about the India's monetary policy and India's financial markets, unfortunately. I think the issue here in the US context is severalfold. One is the initial taper. They could do it very slowly because they changed their policy in terms of how they actually conducted monetary policy to being one where they needed a lot of excess reserves. That's a very different policy than existed before 2006, where in fact excess reserves were at minuscule levels, and that's the way they operated in monetary policy. And in fact, there was a period where they started to taper, and in fact, they tapered too much, even though they slowed decline, that actually there weren't sufficient reserves, even though the amount of excess reserves was 1,000 times what it was before. The change in monetary policy actually, monetary policy, the actual execution of monetary policy, the whole procedures changed sufficiently that they actually needed to, instead of having $1 trillion of balance sheet, they needed $4 trillion. So, and that's actually meant that they could go much slower. So this has to do with the detail of going from a policy of having very little excess reserves, where it was a privilege, not a right, to borrow at the discount window from the Federal Reserve, and the change to now being a right, and a system where, in fact, the main tool no longer is open market operations, but is the interest rate that they pay on excess reserves. So there was a really major change here, and I think that explains very much why the U.S. policies worked the way they did.
Okay, I think it's the same thing here, but markets don't understand this.
Shima, please talk very, very closely and very loud.
Markets don't understand this. It's the same issue here, because this excess liquidity is absorbed in the reverse repo. It's not really creating money supply or adding to demand.
I'm sorry, I just couldn't hear. Your connection has some problems, so that's why I'm having trouble.
Because these computer people had come, I'll ask them to check it.
Okay.
In any case, then there's a question about inequality. Have these policies created asset bubbles and inequality?
Yeah, so I actually think that income inequality is one of the biggest problems that the U.S. faces going forward. In some ways, it actually may have been more serious than climate change. Climate change is a world problem, but and the reason I say this is because it's creating horrendous politics in the United States. I've never seen anything like what we're seeing in the United States. Our democracy, by the way, is under threat right now in the U.S., which is a very, very scary type situation. And I think a lot of it is about income inequality, and particularly educational inequality. So that if you're highly educated, the group that is sitting at this meeting, you're all highly educated, and this is a worldwide problem. Highly educated people are doing extremely well, and if you don't have education, you're in deep trouble. And so this has been a big, huge problem, and it's a very hard problem to solve, by the way, because it's throwing money at education is just not solving it by itself. It actually requires good policies, and there's issues about teachers' unions and whether they're doing the right thing or not. It's issues about what's going on in families and family structure. It's very, very complicated, and you, of course, know this very well because it's been a big problem in India, just as it is in the United States. So I consider the income inequality to be hugely important, and also tears at the fabric of what the U.S. has always been about. So the U.S. has always been a country which actually has had reasonably high income inequality, but within generations, but not across generations. So the issue always was that my children will be more successful than me. If they work hard, they can get rich. And in fact, frequently they did. My family is a classic example of this. My grandfather came to the United States, was something that's called a peddler. He would actually carry things on his back door to door to sell them. And he never, and my father grew up very, very poor. And then my father was a successful businessman. He went to City University in New York for free and got an education and became very successful businessman. And then I'm the third generation, I'm the scholar. So this is a classic pattern. The problem is that that ability to move up the ranks over generations is actually now worse in the United States than it is in many other countries. And that creates huge political problems because you get very bad policies. If you look at Venezuela, one of the reasons Venezuela ended up a disaster was it was a rich country which had very high income inequality, and then got fights between an elite that basically stole for themselves, and then they got another elite, which is Maduro and his crowd and Chavez, and they basically, their elites then also stole everything. So it's a disaster, and of course it's a huge problem, and one that India, of course, has as well as the US. So on the other hand, what can the central bank do about it? I think that it's not the central bank's job to solve these problems. Now, it is true that central bank policies can affect income inequality. One of the things we've seen is that the Fed's very low interest rate policy, very expansionary policies have been very good for asset markets. And that means that anybody that owns stocks has done extremely well, me included. That creates a lot of inequality. So my financial situation is much, much better than it was before COVID. And also, highly educated people work through Zoom. So all of us are able to keep our jobs. So I was earning the same amount of money. My assets were going up in value. And I didn't have to commute or spend or anything else, so I got richer during this period. So there's no question that the Fed policies can affect quality. The problem is that if you want the Fed to deal with income inequality, it can't do its job on the things that it really can control, which is inflation and also stabilize the business cycle. So in that sense, the Fed has the wrong tool to deal with it. The Fed basically has to stick to what it can do, and I think this is true for other central banks as well. I think that the Reserve Bank of India should not focus on income inequality, even though it's a big issue. It should not focus on climate change.
The argument is that low interest rates. No, the
I'm sorry.
argument is low interest rates. The argument is low interest rates.
I'm sorry, I can't hear your word. It's just you go in and out. So, and also, unfortunately, I'm at home and there's a noise behind me because there's people with leaf blowers that just thought, okay,
that's something, right? So I think it's photo time now. Okay. Everybody, just put on your videos. All participants, they're going to take a photograph. Yeah, I think the organizers have done it. So it was a wonderful session, Professor Mishkin. I don't know if you can hear me saying thanks now. Maybe somebody else should say. Okay, so thank you. Good night. Can others hear me?
Yeah.
Okay.
Thank you very much. I enjoyed it.
Thank you.
Yes.
All of us enjoyed it very much also. Messages are full of praise. Huh? Thank you.